Good morning, Mads. How are you?
I'm very good. Look, it's all been chatting about the interest rates and the RBA and inflation. And yesterday, after their monthly meeting, the governor really tried to douse down expectations of an interest rate rise. But the market is still very clearly thinks that we'll be at nearly 1% by the end of the year.
It is indeed, and he tried to put real cold water on that expectation, as he sort of alluded to, the patience, the wait and see, looking at what they refer to as data. So realistically, it's around employment. And as he said, what we were waiting to see is the close of the markets that actually sort of price the idea that rates are going to move. And looking this morning, they are still above 1% by December. So the expectation, therefore, is 4 rate rises in 2022. This is a bank that is trying to tell us very clearly that they are trying very hard not to raise rates in 2022. And if they are, they may do it once, possibly worst case scenario twice. So there's a big disconnect here between who's right and who's wrong. And his national press conference meeting today in Sydney will be, for us in this industry, just as fireworks as obviously Scott Morrison's one was yesterday, because there will be a lot of questions thrown at him about how he sees that transpiring and how he's going to navigate a scenario where we do have high inflation.
Well, I mean, it's not that long ago that Governor Lowe was actually saying, look, not until 2024 will we have interest rate rises, and it's been a pretty quick turnaround if we actually do see them this year.
Yeah, it is. And still, I would say that he hasn't necessarily said that that is out of the factor either. So 2024 is still probably the line, although it's definitely changed. He hasn't explicitly said that. The other thing I want to highlight there, Mads, that you're talking about that is also very, very key to this whole discussion. There is a whole generation of homeowners and personal borrowers, etc., that have never experienced a rate rise in this country. So the last time we had a rate rise in this country was November 2011. So we're talking about 11 and a bit years. And that's a long time, over a decade.
Well, and particularly if you take into account, Evan, the other major piece of data that we got yesterday, which was the CoreLogic house prices, 22% the average dwelling's gone up by in the past year in Australia.
Yeah, and it showed that December is still powering on. It's slowing, there's no doubt about that, but it's still powering on. What was also clear out of the data that came out yesterday is that the home loan growth is still very, very strong, even in December, which is traditionally a very slow month because of seasonal factors like festivities for Christmas, etc. That was fascinating to see. It also therefore confirmed what we probably already knew anyway, that Australians now have the largest level of debt they've ever held on record. And that includes not just your home loan, but personal loans, so credit cards, etc., car loans. All those loans together are now at a record value and a record volume. So again, that question and that discussion we've just been having about interest rate rises is why today's talk from Philip Lowe will be so important, because increases will certainly start to tighten that bottom line.
And I just wanted to pick up on, you mentioned there the PM's press club address yesterday. My ears really pricked up at one thing that he did say. He was talking about helping over 300,000 Australians get into homes via various assistance measures. He says, but we can't manage what happens to house prices. We can help people get into homes. That's actually not correct. There is federal policy which does affect house prices. Think negative gearing, think the assets test for the pension, think all of those assistance programs. All of those do actually have the effect of pushing up the house prices.
They do, and along with the other programs they've had, which was the first homeowners grant and pushing people into it. The reason you ask it that way is that what they are effectively doing is creating demand. So they are giving people that may not have been able to get into the market the ability to get in. So therefore, it's just simple economics. They're creating demand. They're allowing people to enter the market. Demand, and the best way to sort of answer that question, if you look at between 2020 and where we are now, the biggest mover in actual volumes of housing was houses valued between 600,000 and 800,000. And that band was actually the fastest moving up as well. And that's where most of the government policy was. It was about trying to help that middle to lower end get into the market. If you all of a sudden have all of those people looking for houses with supply that was really limited, that just simple economics shows you that price goes up. That's inflation. So I find that an interesting comment, because you're right, it isn't true. And government policy has been there to support that market. Home builder is another one. You could also argue it's the other way around, in that you're improving people's homes, yes, maybe to live in, but also maybe to sell. So there is many programs that have happened, not just over the last 2 years, but over the last 10 years, that have been deliberately designed to try and help the housing market for people, but therefore the price comes with that as a byproduct.
Yeah, it's very interesting, isn't it? All right, Evan, thanks so much for going through all of that for us.
Thanks, Matt.